Loud. Okay. So, hi, everybody. I'm Diane Gubin, co-CEO of C-Suite, and we are so happy today to have Christina Chen-Oster. Christina's company is M Squared,
M2M
correct?
Capital.
M2M Capital.
Yes.
And Christina is going to talk to us about corporate valuations today, and I'm just going to turn it over to you, Christina. If you could tell us a little bit about your background, um,
Sure.
let's go.
Okay, terrific. Thank you. Thank you so much for the opportunity to share what we've built. So by way of background, I started in finance after graduating from MIT. I was recruited to a Wall Street firm that doesn't exist now. It's called First Boston back in the day in 91, and then it's changed over the years to many iterations, and now it's part of UBS. And from there, I worked at a number of other investment banks. I worked at Goldman Sachs for 8 years, where I led the structured products distribution. And then I worked at Deutsche Bank for 13 years, where I led the institutional solutions and equity structured products distribution. So creating kind of derivative and innovative products based upon underlying securities and understanding how to create liquidity where there was no liquidity before, because these are new type of financial instruments. And then from there, I became a founding team member of a firm called S64, which is very similar to a firm called iCapital, if anyone knows iCapital. So it's a firm that creates feeder funds and structured notes that are tied to alternative types of strategies, such as private equity, venture capital, infrastructure, real estate, private credit. And so they create these feeder funds and structured notes that provide access primarily to democratize the availability of these type of products down to as little as 10,000 euros. And the audience is primarily Europe as well as Asia type of clients, but many of the asset managers and products are based in the US. And so one of the pain points that they had was creating valuations of these open-ended products. So the products themselves can be exchanged from one investor to another. And so we set out 2 years ago to solve that pain point, but really the pain point is the general illiquidity of private markets. And I'll go over a little bit of a presentation of what we put together in terms of our firm overview, just so that we have some talking points. So should I go ahead and share my screen for that? Can I do that?
Yes, you have a co-host, so you should be able to share the little green button on the bottom. Yes, terrific.
So this is what we're trying to solve. It's it's the illiquidity in the VC and private equity market, which invests in private companies, right? And so who are we? We are essentially and how do I close this? Close this down here. Okay. We're a technology platform. So we're providing real-time private market valuations, and that's for the purpose of price discovery, risk analytics, and to generate liquidity. Because we believe that by having the real-time valuations and the connections, that helps to power liquidity in the ecosystem. So that's what we're trying to solve for. And then we're also helping, as a result, private company executives, investors, and lenders to be able to use that data in order to generate transactions. So that's what's powering the liquidity. And you have the mutual funds that require daily valuations. And so the system that we built provides essentially real-time market-informed valuations of the companies that are on the platform. And we currently have about 4,000 of them. And so I'll share that with you in a little bit. And so this is kind of what we see as a big problem is the illiquidity. And so I thought this was really interesting to see these type of statistics. So when you have in the public markets, it's a 62 trillion market cap. And you have on average around 125 to 150% turnover per year. And we all know it's very, very easy to trade in the public markets, right? You type into your Robinhood account or Schwab or Fidelity or any accounts. You want to buy and sell Apple, it's seconds, right? Because it's all centralized on the exchange. However, in the private markets, there's no centralized exchange, right? And so that's why, even though it's still a large market, it's about a fifth of the size, it's 10.5 trillion. the amount of secondary trading is less than 3%. It's really small. And really, there's three reasons why. I mean, we'd say some of them here so you can see this. It's the information asymmetry, where you don't have information between one player to another. So the investor has much more information than those that they're looking to sell it to, right? The pricing is really opaque. So you don't know what prices are out there and where the secondary market is. And then there's this disconnect between players. They have to go to advisors or a platform. And then when they do want to transact, you can have a huge institutional player like a T. Rowe and a Fidelity, and they agree upon a price that they want to exchange for that private company. They still will need to go to like a NASDAQ private markets or a platform like a Forge or EquityZen or Augment. And then what do those platforms need to do? They still need to go to the company in order to transact, right? So NASDAQ private markets will need to go to
Is it just it looks like
Yeah,
Christine's on mute.
I know. Christine, I think you went on mute. You are. You are on mute, Christine.
Yeah.
You're still on mute.
Yeah. Christine, can you unmute?
Christina, on the bottom left.
Unknown caller.
Sorry. You're still on mute there.
Did I lose you?
Yeah, no, you're back. Yay. All
Okay.
right.
Sorry, I don't know what part because I guess it got disconnected on my phone, so I'm back to my desktop.
Oh,
Oh.
you are on mute.
Did you lose?
You know what? Why don't you just start at the top of the slide and just kind of whiz through this one?
Okay,
Well, we did
sorry.
get most of the beginning.
Yeah. I need to go off camera for another moment. I'm sorry.
Okay,
Go on.
so on this slide, I was explaining the difference between the public markets and the private markets, right? So in the public markets, it's so easy to trade shares, right? You'd go into your Fidelity account, Schwab, Robinhood, it takes seconds. You type in you want to trade Amazon, Google, whatever. It's milliseconds. So that's why you've got this 62 trillion public markets, and the turnover is 125 to 150% on average. In the private markets, it's much less. It's only less than 3%, even though it's about 20% of the size. And so as a result, it's a result of these problems. So the issues are primarily threefold. Number one, you don't know where the access is. There's information asymmetry, right? In terms of where you can find information. The pricing is really opaque. You don't see what's going on in the secondaries market. It's hard to find that information. And then once you do have two players who agree on something, there's a disconnect and a friction to trade. So for instance, you may have T. Rowe and Fidelity agree on a price on Stripe. And that might have gone through an advisor, or they may have known each other and spoken directly. They'll go to like a secondary platform, like a NASDAQ private markets, Forge, EquityZen, Augment, any of those. What happens next is then those platforms need to go to the CFO or the executive office of that firm, of Stripe, and say, please, we'd like approval to transact and to transfer shares. And so that transfer restriction causes a tremendous amount of friction and delay, because that process can take a month just to get the ear of the CFO, for them to focus on it, for them to process the docs and agree, and they can say no. They can say, I don't want to have Fidelity on my cap table because they've got the full control of the cap table. So as a result, that makes it very difficult. And now there's more and more solutions that are coming into play that are going to be helping in the secondary trading market, which is really exciting. That's not going to be our role. Our role is just the valuation and discovery piece of it, but it goes hand in hand with some of these solutions that can help with the secondary marketplace. So I'll give you an example. Now, for instance, you can invest through SPVs into a single asset. So say you create an SPV into a share, like 10 million shares of Stripe. And then you don't need to go to the CFO of Stripe in order to get that because you're just trading the SPV shares instead. And what you're starting to see is some interest in putting onto a token, even a token linked to an SPV, which has ownership in the underlying shares that are private. And so then when you have these tokens, you can have the tokens have a valuation layer, which shows what that price is. And then that token can trade on different types of exchanges, for instance, like a securitize. And that is starting to generate more and more liquidity in the system. But those type of innovations are what's really exciting because what's happening now is you may have someone looking to sell, like an employee selling shares. Where do they go? They'll go to like an EquityZen. Or you may have endowments who may want to be selling shares in their funds, like a Harvard or a Yale has been very public in Harvard looking to sell $1 billion of their private equity fund interests, or Yale looking for up to $6 billion in their private equity fund interests. And so they'll go to typically an advisor. So it's very public that Harvard is going to Jefferies and Yale is going to Evercore. And then what do? They look for buyers typically from secondary asset managers. Well, they'll just look at the prior GP's marks, which may be stale, like for June 19, it's likely going to be like a March 31 marks. So it's stale marks. And then they'll negotiate based upon those marks, and it'll typically be at a discount, right? And so when a secondary asset manager buys those shares in those LP interests or even in direct company, they'll mark it right back up. And so that's a way for a secondary asset manager to essentially arbitrage, that discount because they're just marking back up to the last marks. And so it's important to know what the real time marks are to be able to properly negotiate and have full price discovery. So for instance, we calculate the impact just last year from all the discounts. And on average, discounts are around 30% in the secondaries market. That impact last year was 48 billion in value that was left on the table. So secondaries is just part of what's important for valuations, because valuations can also be helpful for structured secondaries, for when a company would like to put out a tender offer, for instance, whereby it allows employees to get liquidity in their shares and they have investors who are ready to invest in a company. We talked about M&A, right? I think Virginia had mentioned M&A is really important to know what the valuations are. And so by having valuations all the time, and that's what we're providing is that system for real-time valuations, it will help with the M&A discovery process from a pricing standpoint. Acquisition timing as well, and then credit, you're seeing more and more NAV-based lending lines, not only to fund managers, but also to, that are on the equity side, but also on the credit side, private credit. And so what we're building is an ecosystem where we're connecting different players in the marketplace, but centered around the valuations that we provide. And so our approach is providing these valuations, which I'll go to next in terms of providing a demo of what our system looks like, but then also connecting folks because you want to know the valuations, but then have something to do with it too, like some sort of action with the valuations, whether it's a secondary, M&A, IPO discovery price, or a structured secondaries. And so what we provide from a valuation standpoint is for different types of users, it's different use cases. So for instance, for the private companies, based upon our valuations, we're providing board and investor valuation summaries centered around our approach. For asset managers, it's valuations for NAV calculations. So we can provide, for instance, confidence ranges. So as a result, for asset managers, this can be eligible for NAV calculations. For limited partners in those funds, shadow NAV calculations and GP NAV oversight tools, which allows the limited partners to compare what the valuations are that we provide, because then it's standardized, kind of a benchmark approach compared to what they're seeing from the different asset managers. And then for the platforms and secondary advisors and secondary platforms, it's the ranges to support the transaction pricing. And then we're talking to a number of index providers about providing just the data underlying the valuations so that they can create indices. Because there's no real large number of index on the private assets themselves. So you see, for instance, indices that are on like fund performance, but not so much on private companies themselves. Okay, so I'm going to move now to a demo of what we provide, but this kind of provides a little bit of a snapshot of something that we're very proud of. And that is the fact that we've built a system, and the goal of what we're trying to provide is real-time valuations that predict if a capital markets event were to happen today, whether it's an IPO, acquisition, another financing round, or bankruptcy, what would be that valuation? And so in December, we had an out of sample, for instance, of Databricks. They announced their Series J at a 52 billion pre, 62 billion post. So at a pre is 52 billion, and it was very close to our 50.27 billion valuation on that day on our system. So it's about 3% away. So I'm going to, and then this shows the custom analytics and our valuation methodology, but I'm going to switch over to our platform so you can see exactly what that looks like. Oops. I'm going to move this here because I just have one screen. Okay, can everybody see this? Okay, so I'm gonna just click on, this is our homepage. So it's just a software kind of subscription model. And you can log in. Oops. There you go. So what you can do is you can create a number of different portfolios. And so by creating portfolios, it's like creating different trackers. So this is good for market intel and comparing, if you're doing some research on a company, compare it to a segment of companies. So I'm just going to create, I think I started to create a C-suite one. I'm going to, okay, I'm going to create a C-suite. Okay. So we're going to create the C-suite portfolio. And I'm just going to do a very simple, coming up with a few names and maybe some other kind of examples. So let's say we calculate the Databricks. And just type things in. Labs. So you can add things like that. And then you create this portfolio. You could also add by like by industry. So let's say you want to look at fintech, something like that. And that will bring up companies that are fintech. Let's go fintech here. And let's say, let's count. Akamai. I'll just do a couple other ones, just for example. So now you've created this portfolio of essentially these companies. And so one of four things can happen. This shows you just some basic information about each of the companies. So you see the company name, the website, when it was established, the industry. This is our identification of the industry, number of employees. If it was acquired, it shows the exit date. So the price is only to this exit date. If it's bankrupt, it's only to the bankruptcy date. These are still companies that are private. And then the other thing that could happen is it could go IPO'd. So this company went IPO'd. So the valuation is only until April of 2021. So now you've created this portfolio, but you can create multiple portfolios. So this is a way to just to get like some benchmarking or some trackers, if you will. So once we have this portfolios, you can run pretty simple portfolio analytics, which include looking at what the valuation is to yesterday for the last 12 months in the prior calendar year, 15.15% in this case. And this just shows some very basic industry breakdowns. And then you could see a comparison of the returns of this portfolio that we just created. So for instance, Fanatics or Ampla, I should say, is minus 13.6%. The average industry return for financial technology companies, 9.67, and the best performing one is 226.15%. So this is just a very simple snapshot where you can compare one versus the others. But I think that what people really like seeing is how is one specific company's valuation determined. And so I'll share that with you now. So let's go into the C-suite portfolio. And let's go into the say Stripe, for instance. So this is how we come up with a valuation, and it's real time. So it's very different from what you see anywhere else. So for instance, if you go into Yahoo Finance, you can look at companies, but it doesn't move on a day by day basis. So I'll give you an example. So if you go into like Yahoo Finance, you could type in like Stripe here. Here. Stripe. So here it's loading this price chart for Stripe. And Yahoo Finance gets this from two secondary platform players, Forge and Equity Zen. But notice it doesn't trade that much. See, it's like flatline for months, and then it moves up a little bit. And it's not a real-time price chart because it's just based upon very episodic trades.
And is Stripe public or they're not public?
Sorry, Stripe is
Uh,
not public.
They're not public. Okay, thank you.
Yeah. So that's why it says .pvt. And so there's other companies that here's all the private companies that Yahoo Finance shows. I think it's a little bit less than 200 companies. So for instance, SpaceX, here's another one, a very popular company. This looks a little bit more about like a stock price chart, like it moves a bit, right? But not like a typical stock price chart that you would see for a public stock, because you don't see it priced every single day. And the difference is when we price, right? We show this every day. So then how do we generate this? So what we do is we use AI in a lot of our process. So we use AI in first generating industry names and then mapping the private company to those industries. So Stripe is mapped to financial technologies, but sometimes there's companies that are because they're representing different things. This happens just to be a fairly clean one, it's just one. And then for a SIC code, it's mapped to business services. So then what we do is we use all the public stocks that are in business services to calculate what's called this PME. Oh, Virginia, you have a question?
Yeah, I want to know, since you were comparing your portfolio to Yahoo, where do you guys get your data, and how often is it being updated?
We update every day our data, which is why every day there's a new price that shows. And then in terms of where do we get our data, we have a number of data partners where we obtain a lot of data across all these companies, not just the 6,000 companies that you see that on the platform, but others as well. And we use that to build our model. So from a process standpoint, our methodology is one where it's very different from your traditional valuation methods. So your traditional valuation methods is using three valuations. It's what's called a cost method, a market or peer transaction method, and DCF method. And all three methods are very subjective. And someone had talked about the subjectivity at the beginning of this call, right? Very subjective and highly susceptible to very sensitive to assumptions. So for instance, the cost method is, recreating that company. The market method depends on what are the companies that you choose as peer comparisons, and then you're using those multiples, and then you're establishing, discounts or premiums depending on your views on this company versus those that you've chosen. The DCF method represents having a forecast of your revenues, which is very subjective, right? And then figuring out what discount rate, which is also very subjective, and small changes in discount rates makes a big difference in terms of valuations. And so many valuation practitioners use a blend of these types of approach, but it requires a lot of subjectivity. And as a result, that's what's creating this friction of taking a long time, right, to come up with a price. And then a lot of times I've even heard from asset managers that even within the committee, there's disagreements on what the valuation of a company is, right? Within one asset manager. And so as a result, there's not really a systematized approach. And so what we're doing is creating the systemized approach. And the way that we do it is we take in all this data, which includes transaction data on IPOs, acquisitions, funds and bankruptcies. Those are the capital markets events. And then we combine that with returns that are happening in the public market. And we combine that also with company characteristics so that we can predict. Our goal is creating a model that predicts what a price would be if there was a capital markets event today. So that's our goal. And we started with over 100 factors. So one of my co-founders has many, many degrees, way smarter than me. He was like Wharton #2 in his class and London School of Economics and PhD from UT Austin in financial economics. So his name is Ronnie Shaw. He worked with me at Deutsche Bank. So he led the quant equity strategies team for a couple of years there. But he also spent many years at BlackRock, a research-oriented firm called Dimension Fund Advisors, and a hedge fund called Fort. So he's the one who kind of built the foundational infrastructure from a modeling perspective, for our model of understanding these factors. And then from these factors, we decided on 9, but through a combination of those that are most predictive, independent, and statistically robust. And so that comes down to these 9 factors down here. So that's kind of our approach. But I think that in answer to your question, it's taking in a lot of data, and then every day it changes. And so every day we're running this, and you can see what the attribution is. So let me tell you kind of the approach of how we got here. So what we know are known facts are these rounds. So Stripe did fundraising rounds on these dates, and we put a range of the dates because our data partner does not want us to show the exact information because people will come to us for the exact information rather than them, but it's in there. And so what we do is we use this public market equivalent, which is based upon the equal weight of business services in this case, to calculate what's called a beta. So the beta is the ratio of the difference in returns for the private company, so Stripe, to the public market equivalent. So those are known numbers. So by knowing those numbers, you calculate that ratio, that's beta. And then as a result, you know the day by day move. And that's just in the past. But then you also use this business services return as one of the factors to calculate today's price. And so that's down here. So you can either click on this to get down there or just scroll down. But essentially, what we have are currently 9 factors, but we're in the process of doing some R&D to add 2 more factors, whereby we try to be very transparent to the extent we can about what the values are for each of the factors, the definition of the factors, and the impact on return of each of the factors. So the relationship of factors to return. So for instance, I'll just go through these kind of one by one. But if you click on the definitions, you can see what each thing is, the factors, what the definition is, and the relationship of the factor to returns. So secondary share transaction price is one of the few factors where we cannot disclose the value, and that's because we've signed agreements with our data partners where we cannot provide that. But based upon the secondary share transaction price, and this shows that there must be some good demand for Stripe, that has had a return attributed of 45.9%. So that is actually the bulk of this return. It's up 43.46%. And this is a method where we take the last capital markets event. So it's March of 2023. So we assume that's a real event because it's happened, right? And it's a significant event. And then based upon that, what changes have happened in the market so we can predict what should be the price today on a price per share basis, if that makes sense. So the secondary share price, this is 45.9%. Same stage comparable return is where we take companies that are same stage. So in this case, Stripe is probably around an I because this is around 10. And so we'll group them together. So it might be stage I and J. And so those 10 companies that are I and J that had a round at that time in March of 2023 and just closed another round is minus 6.4% on average. And so that gives you this. And these are the same stage. So these are all the companies in the same stage. And then this is the returns that they realized based upon having a transaction around that time and closing another transaction. So you actually have a realized return of company that's similar that has had events happen. And then here next, we have capital raising interval. So the last time this raised money was in March of 2023. So that's already been 2.25 years, right? And so that time period is a long time ago, which is why this is minus 15.3%. Now we're not trying to do a thesis of we think that it's, it's good or bad, that it's been a while, and then that's why it's minus 15.3. This is just a machine learning algorithm running all the numbers using these factors for the purpose of predicting if there was a price today, what would be that price? And so in this case, it's minus 15.3% return attributable to that factor. The next one is public market equivalent return. So business services had a return of 37.8% since then. And so that return is attributed to 12.6%. So that's what that is. And so as a result, that shows that that's high relative to other SIC codes, other public market equivalent, which is why that's positive. If this was the same as on average as everyone else, all the other PMEs, then this would be 0, because all these returns are on a relative basis to others for that same factor. Funding per employee is the amount of funding that this company has raised divided by to date, divided by the number of employees that it currently has. So this is 633,000. That is high relative to other companies, which is why this is minus 11.4%. Relative employee growth, that's up 18% since March of 2023. And so that is high growth, which is why this is up 10.9%. Same industry transaction return shows the industry, so same fintech type of industries that had this return is 72.7%. And so that's up 10%. And then lastly is rounds of funding. So number of rounds of funding, and that's up 8%. So when you add up the returns that's attributable to each of these factors, that's what gets you to this 43.46%. Does that make sense in terms of an approach? So it's what we call a back solve approach, combination of hybrid of back solve and market peer or market transaction approach. So it's what we call a market informed real-time valuations. That was a lot to digest. Any questions?
I had a quick question.
Yeah.
Because this is AI based, or on that back end that you have, what are the kind of the checks and balances to make sure that AI has the correct information?
Oh, that's a great question. So we spent a lot of time on data cleanup actually to make sure that outliers are flagged. So if something doesn't make sense, that's removed because that hurts the kind of the data for the machine learning to learn and be trained, and therefore the output would be negatively impacted from a accuracy standpoint.
Sure. Thank you.
Sure. And so one of the things that we also provide that helps with financial reporting is these confidence ranges. So since there's like a distribution of returns for the other transactions that are in the database, we show a distribution of what could a potential valuation be at the 25 percentile and at the 75 percentile mark. And so that's helpful for when you want to have like guardrails for a limited partner to compare what valuations they may get from their asset managers. So for instance, Stripe is very well held by many different asset managers, and you may see valuations that are very different across different asset managers. So for instance, I think Morningstar did a really interesting study back in September of 2022, which showed for ByteDance a comparison of a number of different managers that showed returns. For one went up 50%, and for another one was down as low as down 90% within a 1 year time period. So it begs the question of like, what is the right valuation? And the issue is managers have a lot of flexibility in terms of how they determine manager marks, and there's not a good system in place to have some sort of standardization. So auditors, fund administrators, they don't check what a manager's valuation is. They just check to make sure the manager is following the process that they outlined. So it may be the case, for instance, that one manager is following their process, but the financial details that they're getting is based upon March 31 financials for March 31 marks. Another manager may calculate a March 31 marks based upon December 31 financials. So the data coming in has an impact of what they're using. And so that results in differences in valuations. So at least what we do is we try to make everything consistent and standardized. And then we provide a lot of transparency in terms of how we get to that price. And it's not easy to come up with different prices because there's so much data that goes into what the calculation is. One thing that you can do is we have created this kind of analytics where you can put in a price that say you went to a valuation firm like a Houlihan Lokey or something, or who did a valuation for you. So what you could do is say, we had this valuation that was done, and it was, say, I'm just making it up, like at the end of March at 50, rerun this in the algorithm and see what it looks like. And that will run. So that's going to run in a few minutes or so. The other thing that we're adding in are some factors based upon some very difficult to find information. So we're starting to explore adding in a revenue factor. We did a lot of work looking for different data partners that can provide good estimates of what the revenues are for companies. And so that is going to be another factor that we're going to be including. And then another one is a sentiment factor based upon sentiment feeds that you can glean from like a sentiment score from social media kind of news, like Twitter, for instance. So that's another factor that we're doing. And so there's a few other factors that we're going to be providing. And then the idea is we're going to be transparent in terms of what that looks like. And then from a valuation standpoint, the other thing that we're doing is this is valuations that are independent that we have taken based upon our data partners. But if a user wanted to come in with their own valuations, information based upon their assumptions, we can take that in and provide valuations based upon their assumptions, but it's just for them to view. And then same thing with the company. The company can provide us with information, and we would run it through our framework. And then that goes only to the company, but the company can approve who it goes to. And so that's the idea of what we'd like to build in the future in terms of sharing information to help the whole ecosystem.
Wow, it's really robust what you've put together here.
Could I ask a question or two?
Yes, absolutely.
Hi. One idea is if you it's easy to understand how this can really introduce liquidity into the secondary market. But would that, you know how a lot of private equity companies and VCs, when they're always looking for an exit, right? And they make the company IPO when they're, in my opinion, or maybe some other people's opinions, not ready to IPO. It would seem that if you have this liquidity, they could get their exit without making a company go public, which might not be in the best interest of the company. And the other thing is, who do you sell this to?
Right. So I think that the idea of who do you want to sell this to, if even in a pre-IPO instance, you can take shares as a private equity fund to different secondary platforms. So, for instance, we've been talking to some wealth management platforms where their clients are looking to diversify and invest in private companies. Right now, it's primarily concentrating companies that people know, like a SpaceX and Stripe and things like that. But a lot of times, these wealth management platforms have clients. They're looking to buy, and the private equity fund managers or VC fund managers are the ones that are looking to sell. But the idea is, well, how do we make that happen in a way that is as frictionless as possible, right? And so um, find finding a way for you to have price discovery and for you to connect are solutions that we're trying to help with.
Yeah, that's what it
That
sounds
part
like.
is hard. Yeah. Oh, see how that
Sure.
popped up just now? Yeah. So now the conference range is much narrower because that was more recent because I added a date of end of March.
I could just add, I know it's hard for me to speak, but I think this model is fabulous. I'm not just saying this as your friend. I'm saying this as
Thank you,
somebody who's been on
Christine.
the street as an investor because there's been no standard. There has been no way besides people's personal models to evaluate companies. And every analyst that comes in will bring their own set of, their toolkit with them. But I love that this model is standardized and does afford you the ability to customize it as you see fit. But it is dynamic, it's not static, and there needs to be some sort of standard that everybody can abide by. So I like 100 million thumbs up for this. And Cristina, you sell yourself too short when you say you're not nearly as smart as your partner, Ronnie, because we all know differently, girl. This is a fabulous idea. I think we can all see its merits, and we all wish you a ton of luck with it as well.
Thank you. Thank you. Yeah, because what's really difficult, right, is normalizing for time. You see all these deals that are happening at different times. And at different times, it means it's a different market condition. So, how do you normalize it for today of what's going on in today's market? So, what we take is a very different approach because it's essentially a bottoms up approach because we're starting at price per share and we're predicting what is the price. And that's what the investor cares about because that's what you're invested in is the price, right? But your typical valuation process is top down because you're looking at what is the company value, right? And doing all these multiples, and then you move to the price per share last. So rather than looking at in the past. So it's a very different approach.
Which I think is fantastic. But I also see the merits in the credit market as well. This is specifically for the equity market, but from the investor point of view, there should be some things also just in the bond market for private companies and standardization of information.
Yes. And we're speaking to some private credit asset managers as well because we think that this can be helpful for them in looking at the valuation of the company because they will need to look at for loan covenants, right? The NAV, the valuation of the company you on a loan to value ratio.
Private placements, anything along those lines too. But I'll stop talking.
Yeah.
And we're heading towards the top of the hour. Are there any other questions or comments from anyone that you'd like to ask Cristina? Just jump right in and unmute yourself.
And we're all for any feedback as well, because we're an early stage company ourselves. So we have not been around for long. Like I said, we just started. We incorporated in August of 2023. And so what we have now is over 4,000 companies that we provide these valuations. We have some users. We'd love to invite everyone to be a complimentary user to give us feedback on what we can do better. But what we're trying to solve is essentially the illiquidity problem for private companies. That's our goal. But there's many ways to do that. And I think we're just one player in that whole ecosystem with the goal of helping with transparency, standardization, access, connection. but there's many different ways to approach the problem too. And there's information that we'd love to hear whether or not it'd be helpful and to, as we further build our product.
Yes, so if you wanted to offer that that code or tell people how they can access that trial, and then it would be great that everybody can give you feedback once they've had a chance and opportunity to go and dive into it.
That would be great.
Yeah. Is there something that you can put on the chat, or is that something that you would want have Beth and Diane send out to everyone? And stop the recording in a minute here. Stop it.
Probably best if I provide to Beth and Diane to send. Yeah.
Okay, great. I'm going to stop the recording, but really, Cristina, I really want to thank you so much. Everybody stay on for a few minutes. Thank you so much for this wonderful presentation and for showing us this tool, because it's really, I could see how this would be invaluable in the marketplace. And congratulations on on
That's our hope.
all the work that you put into this. Thank you.